Hello viewers, once again. Probably didn't have time to watch the first video, but we already have one video going on the channel, so that's really good, I guess. And I'm here back for the second video, actually the same day. So I don't really edit my video or anything, I just speak what I've been thinking about it and then just publish, really. That's what I do. Alright, so the reason I'm recording this video is actually because I came across a very good situation now of hedging positions, from which I think it's relevant to talk about. And the reason I did this is because I am currently right now open at the gold. If you don't know it, that's the XAUUSD. That's how we call it, and then at least how I call it. And the premises of this video is actually to talk about how you can manage a losing trade. So I have and talk about what is hedging on its essence. So what I have here on my hands is now a position that I've already hedged. So basically what that means is putting on simple terms is giving you another opportunity to be right. That's how I put it on simple terms. And how do I do that? You can manage a losing trade very well, and actually just buy some time for you to think about what to do next, or to correct some of your mistakes that you did, and hopefully start analyzing the mistakes that you did and then correct it. Well, basically what we have here right now is our gold, which is actually on this position to short. This is my stop loss, this is my take profit. We are on the stop loss of 2.09% and we are on a take profit of 6.40%. If you look closely, this is where I opened the trade, very far away. And what I did was I had this zone, which I was thinking it would probably bounce off of that zone. So I had my trade set up right here. So I bought a little bit earlier, but what I usually do, I put an alert on the middle of it, or try to put as close as I can to what I think the price will do next. In which case, actually my zone was something like this, something right here, I guess. So yeah, it was pretty much in the middle. So yeah, it was like that. But it's not anymore because it's invalid. It becomes invalid. That zone of testing, it had become invalid. So what I do next? Right. So you can do one of two things. You can do a hedging position. That basically means you are betting against your bet, and that essentially creates 1 minus 1 equals 0. So you're not really making money, but you're not really losing money. So that's the main thing. You are stopped on a certain loss. You are stopped on this loss. Pretty much, I'm stopped on a loss of 0.76%. And why do I think that number is relevant for me? Because in my rules, in my strategy, and what we try to do on risk management on the trading account for my clients and for me as well, it's really important, that part, is that we do not surpass the loss of 1%. So 0.70% is actually a little bit above what I usually do, which is 50%, and I use the 50% line because it makes me less vulnerable if something goes to the downside. But why is this video very important, at least for me? Because it shows you that if you have also another position that you think, oh my god, the market went too far away, or oh my god, the market went too low, what can I do now? It's basically this. Hedging allows you to do that. If you are right, you get a chance of you get a chance to do it again and again and again whenever you like. So with that being said, let's try to explain a little bit of what I'm doing now. What I'm doing is I opened this position, which went horribly bad. I had a alarm set over here. If you break this this little point, which I think was a strong point, telling me it's going to sell. That's why I firstly opened a trade over here, because it did test and when was showing signals that was starting to go down. So what did I do? I put an alert right here, and I put a stop loss a little bit above. So what that tells me is that, well, at least for me now, I think this is relevant enough for me to say, okay, if broke right here, probably won't be coming down, and we are looking for a more bullish market, which is very true, because unfortunately I did not follow one of the other main things that I do sometimes, which is go to the flux algorithm and the flux data and take a look more closely on what's going on. So as we can see, the market have been bearish since the 26th of September until the 10th of October. Let's go back to the chart and let's take a look on that. So September, sorry, I forgot the date. Let me go back. The 26th. Okay, so the 26th to the 10th. The 26th, that's around here. And as we can see, yes, the market actually have been the 26th to the 10th, 10 of 10. The market has been bearish market. So yeah, that is true. All right, we are actually 2.75% bullish. But there is something else. If you looking for data analysis, you can see market have been bearish for most of the time, and then it's actually on the heat map. We can see that that's not as further as it can goes on a bearish market. There is room for a little bit more. What I was not considering is that it was gonna test one of the major zones for the flux, which is this zone right here on the 100,000. So it did come back, it tested the 100,000, which is correlated to this price right here on the 10th, pretty much on the 10th. Yeah. So a bit after the 10th, we started to see market going further, which it doesn't tell me enough to say, okay, now we're looking for a more bullish market. It did not actually. We can see that the price is already low, and that is enough for me, enough information for me to say that if in here on the 27th of September of last year, we did the same thing. We came back all the way to the 100,000 area, which is pretty much this area all right here, and this area all right here, and it started to go up again. We can see some very huge movements to the upside, for me at least, telling me that large companies or large corporations do want the price to move a little bit now to the bullish side. So with that being said, it is for now for me a good idea to look for bullish markets, and that's what I've been trying to do, and that's what I've been trying to figure out. But I thought in my head that we're going to, okay, we probably go a little bit further than that, because we already went to the 16, we already went to the 23, and those are the lowest. It's being actually 14. These are the numbers I was looking for, 14, something like that. And after that we can see a little bit further up. Apparently it's not what's happening over here. It's actually showing me the opposite, showing that the bullish momentum started now. That's where the hedging becomes even stronger right now. So if now I have another zone, which I'm going to test it right now after the price do their thing and just move there. So you can see here, price did not touch once, twice, a fourth time, 5 times, 6 times, 7 times in a row on this area. So that pretty much tells me it's a strong way for me to say, okay, if now that's a strong area, let's bet on it. So what I am trying to achieve here, I put an alarm over here and I put the stop loss a little bit further than here. So that tells me if something goes right, and if we are looking for still bearish momentum, which I don't think is going to happen, hopefully not, but I am looking for this point only for the solely purpose of closing this deal. I'm trying to close this deal as low as I can get. So if here the price tells me it's too high, people are going to start seeking a lower low so they can buy more of the market. That's what I mean. Because in here, we now have this hedging position, and we are looking for to do a little bit of the closest we can to close it in the lowest possible loss, because then we can now integrate with the new buy position. So basically what I'm telling you is that if this doesn't go like the way I planned, then I'm looking for the next zone, and then the next zone, which is this strong one, will be my take profit. Basically it is very, very, very simple math. If you look very closely, this is the total area that I'm willing to lose, 2.9%. If I am right and the price does move further than that, we can close it at 2.09% of the risk. So if 0.9% of the risk is over here at 0.9%, we are looking to close the trade somewhere around here for this trade to be actually profitable. Yeah, profitable, that's it. And then what we are looking for is actually two different variables. To be profit and is to be break even, you have simply to do this zone, because this is the difference between the opening and the closing. So if you want to move it a little bit further, and I want to close this up deal as a break even, pretty much you don't lose anything, because I'll be losing 2.9%, but also I will be making 2.9%. So that's 0 against 0. And basically what that tells me, okay, if I am right and the market moves up, I will be on profit some 0.60% or something like that. And if I am wrong, the market's simply gonna go back to my original position. And that's when this little zone here becomes relevant for me now, because now that I do know that the price already broke this position, it's very unlikely that it's gonna surpass this position down. It is possible, but it's very unlikely because of the things we have here on the flux algorithm. Actually, the flux data, not the algorithm. The algorithm is the other thing. I'm working on it right now. So if that position starts to move down, that's okay, that's good for us. We can probably see it come a little, if we close a little bit further than our opening, that means we have take profit in here, a little bit of take profit. And then if we start to see some movement up again, we can simply retest this zone right here, and then if it breaks, we are on game. If it doesn't break, we do the same thing again. We open a position for the down here as well, and then we hedge this position, this buy position, in a way that we can look for the other way around. Actually, we try to close as with little losses that we can. So either way, you're going to come out either right or in the break-even zone. So that's what's really important about the market, is for you to know how to manage your risk. Since I'm taking in consideration here the 1% rule, I sometimes do, sometimes not. It's really going to depend on the market, because some markets have a tendency to move way further than 1%. That's why in here I have a 2% loss, and in here I have also 1.8% loss, because probably we'll retest it over here, in which case I will close this buy position over here, and then actually this buy position over here, and start to gain momentum with the market for the bearish side once again. But then that's when we come across with only this system. You already know that you can be just as profitable as just by doing that, just by retesting zones. I think there was a really nice guy that I've came across that explained hedging for other markets, like I think was somewhere around the wheat production, that he uses hedging to do trades based on the weather. So that's was a nice thing that I saw, and then it got me thinking on our way to see this position, or actually all the positions that I've been doing in the process of break even, not even break even, but anyway. So as you can see now, I've set 2 alarms, and this is what I do. This is what on the company we try to risk as little as we can to get the maximum as we can. So we can see we have huge take profits in consideration of the risk. For instance, I have 6.40 here and I have 4.7 here. So that's one of the things that we try to do. We take a little as risk as we can and then put the maximum profit on it. So that's one of the things, and that's what hedging is pretty much. You are not stopped out, but you close a position based on possible future anomalies that you might encounter on the stock market, which isn't really actually it is very a common thing that happens. We are wrong all the time we are wrong. We put a buy position on something that goes extremely down and we hedge it. We put a nice position to go to the bearish side as well, and then we simply manage that position. If it goes back, if it tests this one and go back to my price, I close it as little as on I close it as little as on losses that I can, and then I use that position now to start the other way around. And if you are wrong on that position as well, you can do the same thing, but now in the opposite side. So that is one of the things that I do mostly here. I try to I essentially try not to use hedge most of the time. I try to be right most of the time, so we can have no risk at all, and we have just a simple position that goes all the way to where our target is. And now that with that being said, I think that's it really. It's just a quick video, so you can take a look more or less on how to hedge, hedging, on how is hedging done. I think that's really strong. But just bear in mind this simple answer that you have to be all the time while hedging, because sometimes it can be a little confused. Was confused for me at first when I saw it, and it might be confused for you as well. Just remember that your target should be, so you can break on even. That pretty much means that you're not gonna lose anything or not gonna win anything. You have to be on the same, my dog is snoring right now a lot. But you have to be on the same target as your risk. So pretty much if I'm risking 2%, I need a target that goes up 2%, and that's it. So with that being said, thank you very much for watching or for listening, and well, see you in the next video actually.